such an honor and a privilege to be able to be joined by Howard Marks, the legendary investor and co-founder of Oaktree Capital Management. In addition to running a firm that manages $120 billion, Howard is quite an author. His newsletters and memos about markets and economics are read all around the industry and are often across a variety of different trading desks. And he just released his latest book, Mastering the Market Cycle. Howard, welcome to Goldman Sachs.
Thank you, Ashok. Great to be here.
So before we get into the book, start a little bit with sort of your background and history. What sparked your curiosity in finance?
Well, I'm a kid from Queens, and I went to the public schools in Queens. As odd as it may seem, my education, high school education, included accounting. And I liked accounting. My dad was an accountant, so I figured I'd be an accountant, and I went off to Wharton to take a degree in accounting. But when I got there, I was introduced to finance, and I found that more interesting, so I switched my major to finance. Then I wanted to get an MBA. In those days, you could get an MBA right from college, and so I applied to the good business schools, and some of them, Harvard, Stanford, for example, required experience, and the University of Chicago didn't. So I went there. And I had a summer job at Citibank in '68 in the investment research department, and then when I was getting out, I still didn't know what I wanted to do. I applied for 6 different jobs in 6 different fields, and on the strength of the experience that I had, I went back to Citibank into the investment research department.
And so in 1995, you started Oaktree.
Right.
Why?
What we said at the time was that we wanted to have a firm that ran our way. We had ideas on what the right investment philosophy was for us, not necessarily for everybody, but for us. We were in the aggressive, risk-oriented asset classes like high-yield bonds and convertibles and distressed debt and opportunistic real estate and emerging markets, so forth. And our approach was to be the controlled risk option in some risky asset classes. And that was a big part of our philosophy. And everything we do at Oaktree now runs according to the same philosophy. It's implemented differently because markets are different, but the underlying philosophy is the same, and it fits with our personality, it fits with our values, it fits with what our clients want, and so it's very holistic.
I mean, did you ever envision Oaktree becoming what it is today?
The alternative investment category, which is where I place us, went from being an oddball sideshow that you might put a little into to spice up your portfolio to a respectable component of investing, number one. And so, we started in '95. At the end of '95, we had $5 billion under management, and at the end of '97, we had $10 billion under management. And I would say that at the end of '06, we probably had 35. But one of the things that really changed is that in order to pull the world out of the global financial crisis, the central banks pulled down the risk-free rate from, let's say, 3 or 4 to 0 or minus. And most institutional investors have the concept of a required return. Pension funds basically need 7.5 or 8. Most endowments need 8 in order to pay out 5 to support the institution, earn 2 to cover inflation, and 1 to cover administration. So most US institutions need 7 to 8. And today, for example, and by the way, remember that rates have come up a great deal in relative terms. So today, cash pays 1, 5-year pays 2, the 10-year pays 3, high grades pay 4, high yield pays 6, stocks are expected to return 5 or 6. And so the investors have had to turn to alternative investing to get the returns they need in a low return world. And my late father-in-law would call these people handcuff volunteers. They're not doing what they necessarily want to do, they're doing what they have to do to get the returns they need. And so that has produced enormous cash inflows to all alternative investment firms.
So along those lines, if you look at really probably up until July 2016, maybe after Brexit, if you want to mark an inflection point, we've been in this sort of disinflationary bull market run in bonds for really close to 30 years.
Yes.
And so if we are, again, no longer in a bull bond market, forget about calling it a bear bond market,
Right.
How do you think about that? How do you think about, the impact on Oaktree, but more specifically, the impact on how you would invest?
So, where are we? First of all, if you look at history, history says that 0, or even where we are today, is unnaturally low relative to the strength of the economy and inflation. So that says that rates should have been higher than 0 and probably higher than where they are today. Number two, most people who work in the investment business, and I assume all of you, believe that the free market is the best allocator of resources, and that's the value of capitalism and laissez-faire economics and so forth. And clearly we haven't had a free market in money, so we have not had good asset allocation. And borrowers have been subsidized, and savers and lenders have been penalized. I would assume that the Fed would like to get out of the idea of administering rates and let them float freely, and we have to get from bargain rates for stimulus purposes to free market rates. And then finally, well, maybe not finally, but the Fed considers it very important to have the ability to cut rates in order to bail out the economy if it starts to weaken. That's the prime tool, and if the rate is 0, you can't cut it. So I think if I was running the Fed, it would be a high priority to get rates high enough so that you can cut them meaningfully when needed. They want to raise rates to prevent the economy from overheating and lapsing into hyperinflation. So it has been clear that eventually rates would start going up. How could that have come to a surprise to anybody? Who could have been in the investment world or in the financial world and been surprised by rising rates? It's just that, short rates rose for a long time without long-term rates rising. That doesn't make any sense. And eventually long-term rates started to rise and everybody freaked out. But the failure of people to anticipate rising rates and the ability to be surprised by rising rates earlier this month just shows you how myopic and blind the markets can be.
Right. So given that that Oaktree is now $120 billion, and I understand, not all pools of money are the same. Realistically, given the size of that tanker, how much time would you really need to meaningfully adjust a portfolio?
Well, first of all, I appreciate your use of the word adjust, because a lot of people who are less astute than you would say, how long would it take to go to cash? And the answer is going to cash. We don't go to cash, and going to cash under almost all circumstances is stupid. Because, among other things, when you go to cash, you have to be right away. Because if you go to cash and prices keep going up for a while, as they invariably will, and returns continue to be positive, you fall so far behind by being in cash that you may even jeopardize your business to stay in business. And you'll certainly jeopardize a lot of your client accounts. So, but you used the term adjust portfolios. And if you read the book, as I hope you will, you'll see that we don't think about when is the turn going to come or when is the bottom going to come. And in fact, when is one of the words I reject in our business, because we sometimes have an idea what's going to happen and we never know when. The turns that matter, you see, the market is a little bit volatile. I mean, the economy is a little bit volatile. Sometimes it's up 3, and sometimes it's up 1, and sometimes it's down 1. Company profits are more volatile because companies are leveraged, operating and financial. But market prices do this because they're driven by people, by people's emotion, by what we call human nature. And so to figure out when things are going to happen, you would have to be able to predict emotion, which is impossible. And so we don't ever think about when at Oaktree. We think, and one of my mottos is, we never know where we're going, but we sure as hell ought to know where we are. What's going on around us? What does that imply about the future? And if we conclude that the present developments justify a more defensive position, then there's no time like the present. So we start, and we do what we can, and hopefully we do enough before the stuff hits the fan.
And you talked about, sort of the pain associated with going to cash, and then if you engage in abstention and the market keeps going up, then obviously you underperform.
And let's point out one of the most important adages in investing, that being too far ahead of your time is indistinguishable from being wrong.
Absolutely, early is wrong, sure. But along those lines, has that changed over the course of the last, again, call it 25 years?
No, no, because in order to predict and work toward and game for a relative return, now not only do you have to know what's going to happen, but you have to know how other people are going to behave in response to what's going to happen, and you have to set your game for that. So again, it sounds maybe impractical. All we try to do is the right thing. If prices are too high, if risks are too high, if interest rates are too low, then if the economy seems to be getting old, then we try to reduce our risk.
And obviously we came through pretty formidable financial crisis and ensuing recession. Where do you think the market is with respect to remembering the financial crisis of '08, and how much do you think that is manifesting itself in investor behavior?
John Kenneth Galbraith said in his book, Short History of Financial Euphoria, that one of the outstanding characteristics of financial markets is shortness of memory. Now, it's not that people are stupid or their brains don't work, but what it is that sitting here on this shoulder, you have memory of the past and resulting prudence. And you say, well, the last time the market went up this much and this fast and this far, bad things happened. And the last time the PE ratio was 20 and so forth, and the spread was inverted or whatever you want to look at, bad things happen. So I'm going to cut my risk. That's sitting here. On this shoulder, you have greed. Greed wins. Now, under the rubric of greed, I would put fear of missing out, fear of trailing the competition, etc. But these emotions overcome old-fashioned prudence. So I put out a memo 3 weeks ago today entitled "The 7 Worst Words in the World," and I believe they are too much money chasing too few deals, and because when there is too much money chasing too few deals, and the money is in the hands of people who are too eager to put it to work, and who are too driven by fear of missing out, and not afraid enough of losing money, then they bid too aggressively for securities, which takes the form of driving down prospective returns and driving up risk.
So when you decided to write a book, what was the story that you wanted to tell?
Well, first of all, I always thought, I started writing the memos in 1990, and I always thought that when I retired, I would pull them together into a book. And then in '09, I think it was, I got a letter from Warren Buffett, and he said, if you'll write a book, I'll give you a blurb for the jacket. So that catalyzed my thinking. You don't pass up an opportunity like that. And so, the first book was called The Most Important Thing, and it has 21 chapters, and each chapter says the most important thing is, and then it's a different thing. Because, I would find myself sitting in a client's office, and I would say the most important thing is controlling risk, and 5 minutes later I'd say the most important thing is buying cheap, and 5 minutes later I'd say the most important thing is knowing where we stand in the cycle or something like that. So I wrote this, first a memo around 02, called The Most Important Thing, and then this book. You know, there are so many things that you have to juggle at the same time to be a good investor that I wanted to share that with people, you know? And I think I said in the introduction that I am not writing to make investing easy. I would rather write to show how hard it is, because there are so many things that have to be juggled simultaneously. But if you take an area like investing and you try to make it seem easy, you're really doing people a disservice. If we said to people, you know, if you really spent some time on it, you could do your own dentistry or your own legal work or fix your own car, you know, we wouldn't be doing people a favor. And the same is true with investing. For some reason, while nobody does their own dentistry or auto repairs, everybody thinks they can be an investor. And if they're going to try, I'm at least going to give them some of the considerations. So one of the things in that 21 was knowing where we stand in the cycle. Now I think there are two, among the 21 most important things, I think two are really the most important, except for the others. And they are, number one, risk and controlling risk, because I think that controlling risk is the mark of a professional. Anybody can make money when the market goes up, and most of the time the market goes up. And anybody who takes above average risk can do above average when the market rises. So achieving returns is not a point of distinction in good times. In my opinion, the distinction of a superior investor is achieving returns in good times with the risk under control. Because you never know when the environment is going to shift from favorable to unfavorable, and the question is, are you prepared? You know, somebody who, if the market's up 10 and you're up 12 and the market's down 10 and you're down 12, you didn't accomplish anything. The question is, can you make more in the good times than you give back in the bad times? And then I think the other thing that's most important is the cycle and where we stand in it. I don't believe in predicting the future. We never know where we're going. We should understand the present. And where we are in the present, where the market is relative to its cycle, tells you something about the odds that govern the future. Doesn't tell you what's going to happen tomorrow, but I believe that we can only understand, since the world is an uncertain place filled with randomness, we can't know what's going to happen in the future. But those of us who see the world more clearly than others can have a superior understanding for the probability distribution that governs the future. What things can happen, which are most likely, which are somewhat likely, which are unlikely. If you have that consistently, you are a superior understander, and you can be a superior investor. So I think the question is, what today is the probability distribution that governs the future? And one of the things I say in the book, which I'm happy with, is that the future, investment performance in particular, for me, is like a bowl full of lottery tickets. You never know which ticket's going to be chosen. Sometimes the bowl has 70% winning tickets and 30% losing tickets. Sometimes it has 70% losing tickets and 30% winning tickets. Wouldn't it be nice to know the difference? I think it's possible. But you want it, when it's 70% winners and 30% losers, you want to go all in. You want to invest heavily in aggressive securities. And you reach into the bowl, or maybe the gods of fate reach into the bowl, and they pull out a ticket, and it's a loser. So, you know, as my best friend Bruce Newberg says out in California, when we play backgammon, which is a game that's dominated by dice, there are probabilities and outcomes. We can get the probabilities on our side. That does not ensure a favorable outcome, but it's the only thing we can try to do so, and that's what the book is all about.
How did being a writer and author make you a better professional? And specifically, how has it accrued to Oaktree to basically have you out in the public domain as an author?
When I write the memos, I always think of something that I didn't have in mind before I started the memo. I'll give you a simple example, since we've been talking about risk and probabilities. In '06, I wrote a memo with a clever title, Risk. And I tried to put down everything that I could think of about risk that I knew. And so I'm sitting there typing it out, and I wrote that you can't measure risk in advance. You can't quantify risk in advance. And I think that's true. You can't measure risk even after the fact. You buy something for $100. A year later, you sell it for $200. Was it risky? Maybe. The point is, in my opinion, you can't measure risk even after the fact. And that's something that
This revelation came through writing. Yep.
I literally hadn't thought about it before I sat down. In the book, when I was writing about psychology, I realized that there was something that I hadn't planned to write about, that deserved its own chapter, and that was the cycle in attitudes towards risk. Because I think that the way people think about risk has an enormous impact on the market, and it changes volatilely. And people are supposed to be these computers who look at risk-adjusted returns and make intelligent decisions on that basis, and nothing could be further from the truth. When the market is doing well, the economy is thriving, and companies are reporting good profits, and the media are telling good stories, and everybody feels good, what do they say? Risk is my friend. The more risk you take, the more money you make. And I feel entirely comfortable taking risk today. And by the way, I don't see any risks on the horizon. So bring it on. And then, for the next year or two, the economy suffers, corporation profits disappoint, the media now turned into telling scare stories, the prices are cascading down, and emotion goes through the floor. And now what do people say? Risk-bearing is just another way to lose money. I don't care if I ever make a penny in the market again. I just don't want to lose any more. Get me out at any price. And this fluctuation in attitudes towards risks probably does more than any other one thing to influence the swings of the market. And again, this is an idea that I had no thought that I would write a chapter about that. So, the great thing about writing is you have to think things through. You can't have some rough, unformed, imprecise view.
It has to be crisp.
Has to be crisp.
Yeah. So,
in order to convince others, you have to convince yourself.
Sure.
Thank you for having me here today. Thank you for doing such an interesting job, Ashok.
Yep.
And I look forward to coming back.
Yeah, thank you very much, Howard.